MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. Since the last policy, the growth inflation dynamics have played out favorably. Growth has continued to sustain its momentum, surpassing all projections. Headline inflation has eased to 5.1% during both January and February, and this has come down to 5.1% in these 2 months from the earlier peak of 5.7% in the month of December. Core inflation has also declined steadily over the past 9 months to its lowest level in the series. The fuel component of CPI remained in deflation for 6 consecutive months. Food inflation pressures, however, accentuated in February. Looking ahead, robust growth prospects provide the policy space to remain focused on inflation and ensure its descent to the target of 4%. As the uncertainties in food prices continue to pose challenges, the MPC remains vigilant to the upside risks to inflation that may derail the path of disinflation. Under these circumstances, monetary policy must continue to be actively disinflationary to ensure anchoring of inflation expectations and fuller transmission of the past monetary policy actions. The MPC therefore decided to keep the policy rate unchanged 6.5% in this meeting and also remain focused on withdrawal of accommodation. The MPC will remain resolute in its commitment to aligning inflation to the target. I would now like to provide an assessment of growth and inflation, and I will begin with the scenario relating to global growth. The global economy has remained resilient with a stable outlook as reflected in various high-frequency indicators. Now in my statement, whatever I am saying, it is backed up with a lot of data which are there in the footnotes. So those of you who are interested could refer to this statement, which as usual will be uploaded in the RBI website immediately after this statement is over. So a lot of data backing up whatever I am saying is available in the footnote of the various footnotes of my statement. You may like to refer to it. Let me start again on the global growth part. The global economy has remained resilient with a stable outlook as reflected in various high-frequency indicators. Global trade is expected to grow faster in 2024, although weaker than its historical average. Inflation is moving closer to targets, but the last mile of disinflation is turning out to be challenging. Services inflation in advanced economies remains sticky amidst tight labor markets. Accordingly, central banks are cautious in their communications, thereby tempering market expectations about the timing and magnitude of interest rate cuts later during this year. Equity markets have gained while bond yields and the US dollar have remained volatile. The overall outlook is challenged by continuing geopolitical conflicts, disruptions in trade routes, and high public debt burden. In the last monetary policy statement, if you recall, I had expressed concerns about the high levels of public debt in both advanced and emerging market economies, that is the EAEs. These are dormant risks which could erupt abruptly. Debt to GDP ratio, which rose during the pandemic, remain elevated and are projected to increase further with rising interest burden and cost of borrowing, thus raising debt sustainability concerns. Worsening debt situation in advanced economies, in particular, can generate spillovers for the emerging market economies in the form of swings in capital flows and volatility in financial markets. The emerging market economies with rising levels of public debt in particular would be vulnerable